More AI phobia as the VIX pops above 20 and the Nasdaq and the S&P tumbles. Right, it was a pretty ugly risk-off day yesterday with equities hit across the board. The major US indexes all fell more than 1%, with the Nasdaq leading the drop as the sell-off in tech and mega caps accelerated. Now, just like the previous push lower we had, this isn't just an earnings story, but the market is getting increasingly nervous about the AI trade from two angles. Firstly, whether the massive investment cycle can actually pay off in profit, and secondly, whether the AI disruption starts undermining business models. Now, this anxiety is spreading. Software names have been under pressure for weeks now, but the fear is starting to bleed into other industries as well. We even had things like transport and cyclicals hit hard, while defensives like utilities and staples held up slightly better. Now, as a pure tactical note for traders, it's always worth keeping the yearly open levels marked on the chart for the major indexes. The Nasdaq leaned against that yearly open level and fell there, and the S&P is currently flirting with that level as well. Now, those are the kinds of levels that can act like magnets when volatility is rising, and on the volatility side, it's always worth keeping that 20% level on the VIX on the chart as well. Above 20, systematic vol targeting strategies can amplify their selling, not because the fundamentals change, but purely because volatility changed. Now over to rates markets. Bonds caught a very strong bid, with the US 10-year yields falling to 4.1% as investors looked for some safety. Now, a few weeks ago, Treasuries seemed to lose a little bit of safe haven appeal, but that wasn't the case yesterday. Over to commodities. Gold and silver both fell a lot, with silver down close to 11%. Now, we've said this so many times. It's important to always remember that when equities go into a risk-off frenzy, gold is usually positively correlated with equities as investors sell what they can, basically selling anything with a higher volatility. So when the brown stuff hits the fan for equities, we often see gold and silver sell off alongside equities. When you look at the data, gold is more a hedge than a safe haven, but that is for another video. Also in commodities, oil was also dragged lower by the risk-off tone, with WTI falling close to 3%. Of course, still a lot of eyes on the geopolitical situation in the Middle East right now. Now, the one market that was unfazed by the risk-off was FX, with only marginal moves in most of the majors, apart from the high beta Aussie dollar, which gave up some of its recent gains. So for the day ahead, US CPI, of course, a next big possible catalyst. If inflation surprises hot, it validates fewer cuts from the Fed, which could put further pressure on equities. But if we do see a big surprise lower, it could set up equities for another end-of-week rally into the close. The bottom line, risk is off. It's real. Levels matter. And when volatility rises, the market can move for mechanical reasons. So keeping size tight is usually preferred in these markets.